Okay, folks, I want to talk about a few just preliminary issues in Chapter 5 that have to do with inventory and cost of sales. And we need to talk about these issues before we get to the meat of the chapter. But let's take a look. Um, when we talk about inventory, and this is a continuation of the previous chapter, um, certainly merchandise inventory, we know that term, that includes all goods that we own and we hold for sale, regardless of where the goods are located. Okay, when we count the inventory. Okay, so there's some special issues that we need to talk about. We need to talk about, well, how do we handle goods that are being delivered or goods that are in transit? How are we going to handle goods on consignment? We'll talk about that. And how are we going to handle goods that are damaged or obsolete? These are all issues we need to address. Let's talk about goods in transit. Okay. Now, think about a company like Walmart, and let's say that they do their financial statements. Let's say their year end is December 31st, and so at December 31st of any given year, they need to say, okay, here is the amount of inventory we have, the amount of merchandise inventory we have. Well, at any given point, there are things being delivered to Walmart from places where they purchased it from. And there's also things being shipped away from Walmart to consumers who have bought that merchandise. Well, so there's a lot of stuff on the road or on trains or in planes or whatever at any given time. Who owns those goods? Who includes it on their balance sheet? Well, we know that only one company can. Both companies can't count it. So this comes back to the transportation cost and the terms that we discussed in the previous chapter. Is it FOB destination or is it FOB shipping point? The rule is this: whoever is paying for the transportation owns those goods while that merchandise inventory is being transported. Let me say that again. When goods are being transported, someone's paying for it. Whoever's paying for it, that is the company that counts it in their inventory while it's being transported. Okay? So that's the key. So the key is to ask, well, when these goods are being shipped or trucked or airplaned away or to your store or to a buyer or whatever, who's paying for it? Whoever pays for it, whoever's paying for that transportation, they include it on their financial statements while it's being transported. Another issue we have are goods on consignment. Okay, I don't know if you ever heard this term before, but sometimes, let me give you an example. The example I have here is this lady works at a Hallmark retail store. Okay, and this guy, maybe he manufactures, or maybe he has, maybe he's just has a small little business in his garage where he makes like necklaces or bracelets or something like that. Well, a lot of times, a local store like let's say an Overland Park Hallmark store, they will allow an Overland Park resident to sell some of the items that they've created in their Hallmark store. Okay? And in that case, the guy is the consignor. All right? He's the one who kind of has created these bracelets in his garage or whatever. And he gives them to the Hallmark store, which is the consignee. And maybe they make an agreement that for every bracelet that they sell, Hallmark store will get a couple dollars. Okay? Now, the key is the merchandise, even though it's in the possession of the consignee, the consignor owns that inventory. Okay? The consignor owns that inventory, even though it's in the consignee's location. The consignee is going to sell that inventory in their place of business, but they do not count it in their inventory. And you might say, well, why would a Hallmark store do this? Well, like I said, they might earn a buck or two on each bracelet that they sell, but sometimes this is just a kind of a goodwill thing where, um, it's a somebody that lives in their area. Maybe it'll get some extra customer traffic from people who are friends of this guy or whatever. But those are goods on consignment. Okay. Maybe you have had the misfortune of seeing the Home Shopping Network, and they're always selling something on the Home Shopping Network. Well, those goods that they have, those are on consignment from some other place. They're trying, the Home Shopping Network is trying to sell those goods for the consignor, but the Home Shopping Network is the consignee. And that merchandise inventory should be included in the inventory of the consignor, not the consignee of the Home Shopping Network. What about goods that are damaged or obsolete? Okay. Sometimes when you do a physical inventory count, you find something like this picture on the right. What are you going to do about that stuff? Well, we're going to talk about that later when we get to lower of cost or market. But this is something that we need to take into account. We're not just worried about the number of items that are in our inventory, but as far as the individual cost per units and those sort of things. So we'll talk about how to handle damaged or obsolete goods a little later in this chapter. Okay. Now, determining inventory costs. When we are calculating, we talked in the previous chapter about how transportation is included in the invoice cost itself. If we pay $100 for transportation of merchandise inventory, we debit merchandise inventory when we pay cash of $100 for that transportation. Okay? We don't debit transportation expense or delivery expense. We talked about that in the previous chapter. And this is just kind of expanding on that concept. Let me give you an example. Let's say we are a piano retailer, and we're one of these stores that you go in and you can buy a piano for yourself or for your kids. There's pianos everywhere. Okay, so we are a piano retailer. All right, so let's say we purchase a piano from a manufacturer, and the cost of that piano from the manufacturer is $2,200. Okay, but then let's say we had to pay $150 to have that piano delivered to our store. Okay, it's not cheap to have a piano delivered. And then let's say the insurance that we had to pay for while we were delivering that piano. Sometimes you'll buy insurance on that delivery in case something happens. Let's say that was $50. And let's say that once we received that piano, then we have an independent contractor, a third party that comes in and tunes that piano. Okay, once it's unloaded into the store, and they tune the piano so that it'll sound nice. Well, only at that point is that piano ready to sell. All of these are necessary and reasonable costs to obtain that piano and get it ready to sell. So the total cost of that piano is not just the $2,200, but the total cost of that piano should be considered as $2,485. Okay, so that's what this slide is talking about. All expenditures necessary and reasonable in bringing an item to a sellable condition are included in the invoice cost. Okay. Lastly, what we're going to talk about is, and we spoke about this a little bit in the previous chapter, is at some point retail stores need to take a physical count of their inventory at least once a year. A lot of times they'll do this at year end. And we spoke in the previous chapter about if the physical count does not match what our inventory records say in our accounting records, what it says merchandise inventory is, we have to make an adjustment. And usually it's an adjustment downward. And I think in the previous chapter, we talked about our accounting records say that we had 10 of a certain type of television, where our physical count only found 9. Okay, so you have to make that adjustment down. So companies need to take a physical count of their inventory at least once a year.